Welcome to Iron Financial. This is the place where we help you forge a stronger portfolio by cutting right through the market weakness. Today, we're putting a true global giant, the Coca-Cola Company, under the microscope. Their latest earnings report just hit the street, and honestly, the headlines are all over the place, sending completely mixed signals. So our mission today is simple. We're going to run a full diagnostic, a complete structural stress test on these financials to figure out, once and for all, if Coca-Cola is the rock-solid financial fortress everyone thinks it is, or if we're finally starting to see some serious cracks appear in that facade. All right, let's get into it. Right off the bat, you can see the problem. This is what's got the market spinning its wheels. On one hand, you've got the company reporting this massive 38% surge in operating income for the entire year. I mean, that's a blockbuster number, plain and simple. But hold on. In the same report, for the final quarter, Q4, they turn around and say operating income collapsed by 32%. How in the world can both of those things be true? It makes absolutely no sense. Is the engine just roaring ahead at full throttle, or has it completely seized up? This is exactly the kind of contradiction we live to tear apart.
Precisely. And this right here is our blueprint for how we're going to do it. We are going to systematically break down this entire report piece by piece, just like a team of engineers inspecting a skyscraper for its structural integrity. First, we're going to check the very foundation. Is that revenue growth actually solid? Then we'll move up and inspect the profit powerhouse to see just how efficiently this engine is really running. After that, we are zeroing in on the biggest red flag on the whole report, that Q4 collapse, to find the true source of what looks like a failure. From there, we drill all the way down to the bedrock, its cash flow and its dividends. And then finally, with all the data assembled, we will deliver our verdict.
Yeah, exactly. This central question is staring us right in the face. Are these numbers trying to tell us that the machine is breaking down, or is it actually running stronger than it ever has, and the market is just getting confused by all the noise? The data on the surface is a complete mess, which means we have no choice but to go deeper. So let's start digging.
Agreed. Any good structural analysis has to begin at the foundation, and for any company, that's the top line. It all starts with revenue. So let's put these revenue figures through their first major stress test and see what they are really made of. All right, so here's the headline number, right from the official GAAP filing. Full-year net operating revenues, they came in at $47.9 billion. That's a growth of just 2% over the prior year. 2%? Is that it? For a global behemoth like Coca-Cola? That is barely keeping up with inflation. That doesn't feel like growth. That sounds a lot like stagnation. To me, that sounds like the very first sign of a crack right there. A company this massive should be doing a lot better than just crawling along. Is this the heavy lifting we're supposed to expect from a blue-chip stock? Because it looks pretty weak from here.
You know, that's a totally fair criticism if you only look at the surface. But the problem is, that reported GAAP number, it's often like trying to assess a building's structure by looking through a distorted, dirty window. To get a really clear view, you have to clean the glass. In finance, cleaning the glass means looking at something called organic revenue. It's a non-GAAP metric, and it is a critical tool for this kind of analysis. What it does is it strips away all the external noise. I'm talking about things like the wild swings in foreign currency exchange rates or the impact of buying one business and selling off another. It lets you see the pure, underlying performance of the core operation.
And once we wipe away all that distortion, the picture, well, it becomes much clearer and, frankly, a whole lot stronger. Full-year organic revenue growth was actually 5%. Now, that is a much healthier number. It tells us that the core business has real momentum. But here's the critical detail, the part you have to really dig for in the filings. This growth was driven entirely by pricing actions. Global unit case volume, that's the actual amount of product they sold, was totally flat for the year. So let's be crystal clear about this. They aren't selling more stuff, they are charging more for it. The ability to just raise your prices and have them stick without your customers running for the hills, that is a sign of immense brand strength. Some people call it a competitive moat. This 5% figure, not the 2%, is the real measure of the company's top-line integrity.
Okay. You're saying currency is a major distortion. Let's quantify that. How much of a drag are we really talking about here? Is this like a light breeze, or are we talking about a hurricane-force headwind? It's a hurricane. Just look at the data points on the screen. The impact from currency was absolutely massive. On their reported earnings per share, it created an 8 percentage point headwind. That is huge. And even on the comparable non-GAAP number, which is already a cleaner metric, it was still a 5-point drag. The strong US dollar is acting like a massive anchor on this ship, dragging down every single number that gets reported back home in dollars. This is not some minor issue. It's a primary reason the numbers on the surface look so sluggish.
All right, I'll concede the organic revenue point, for now. But that just brings us to an even bigger question. If organic revenue is only growing at 5% and the volumes are flat, how on earth does operating profit jump by a staggering 38% for the full year? You can't get that kind of explosive growth from a 5% top-line increase. The math just doesn't add up. So where is all this profit coming from? Is this real operational strength, or is it some kind of financial engineering that's just not sustainable?
This right here is the heart of the bull case. This is where the story of financial strength really comes into focus. We're looking at a jump from just under $10 billion in operating income in 2024 to nearly $13.8 billion in 2025. That's that 38% increase. This isn't some kind of trick. This is pure operational leverage and margin expansion at work. This is the heavy lifting.
Look, the secret isn't selling more product. It's about making more profit on every single product they sell. And we can see that as clear as day in the operating margins on this slide. The reported operating margin shot up from 21.2% all the way to 28.7%. Just let that sink in for a moment. That is a monumental improvement in profitability in just one single year. Even if you look at the cleaner, non-GAAP margin, it expanded from 30% to over 31%. They're structurally re-engineering their entire business to be a more efficient profit machine.
So what's the engine that's driving all this? Well, it's really a two-cylinder machine. First, as we already mentioned, is that immense pricing power. They can increase prices without a significant drop in demand, and that flows directly to the bottom line. Second is effective cost management. They are keeping a very tight lid on all of their expenses. These two factors working together are the steel beams reinforcing this entire profit fortress. It's what's allowing them to expand margins and generate massive profit growth, even in an environment where volume is totally flat. Okay, analyst, you're building a pretty compelling case for a fortress here. It sounds strong, it sounds solid. But you can't just ignore the giant red flag we saw on the very first slide. What about that 32% collapse in operating income in the fourth quarter? A fortress doesn't just see one of its main walls crumble in a single quarter. This looks like a serious crack in the armor, and we need to put it under some extreme scrutiny right now. And you're absolutely right to hammer this point, skeptic. And visually, you're right, it looks terrible. You see operating income fall from over $2.7 billion in Q4 of 2024 all the way down to just $1.84 billion in Q4 of 2025. On the surface, I agree, this looks like a catastrophic failure. It looks like a critical support pillar just buckled under the pressure. But again, the headline number, it just doesn't tell the whole story. You have to read the footnotes.
And here is the explanation pulled directly from the company's filing. The entire drop, it's almost single-handedly explained by one single event, a nearly billion-dollar non-cash impairment charge related to the body armor trademark. Now, let's break that down because this is crucial. Non-cash means exactly what it sounds like. No actual money left the company's bank account. And an impairment is just an accounting rule that says if you own an asset, in this case the body armor brand, and you determine it's now worth less than what you have it valued at on your books, you have to write down its value. So this is purely an accounting adjustment. It is not an operational failure.
Let's just put the full number on the screen to really appreciate the scale of this. $960 million. This one single accounting entry, which had zero impact on the company's cash balance, is the source of all the noise that created that scary-looking 32% decline. If you remove this one item, the quarter looks completely different. This is a classic example of why investors have to be able to look past the GAAP headlines to understand the true structural integrity of a business. This isn't a crack in the foundation, it's graffiti that's been painted on the side of the wall. All right, so we've established that the revenue structure is solid under the surface, and the profit engine is powerful, and we've debunked the Q4 collapse. But now we get to the ultimate test. You see, profits can be influenced by accounting rules, revenue can be complex, but you cannot fake cash flow. The true bedrock, the deep foundation of any real financial fortress, is its ability to generate cold, hard cash year after year after year.
Now, just like with the other metrics, the headline GAAP number for free cash flow is a little bit misleading. The company reported $5.3 billion for the year. But if you dig into the cash flow statement, you'll find a massive one-time payment of over $6 billion related to the acquisition of the Fairlife brand. This was a pre-agreed payment, not a reflection of 2025's operations. So when we add that payment back to get to the underlying operational cash generation, we see the real number. The true cash-generating power of this machine is an incredible $11.4 billion.
Okay, 11.4 billion is a mountain of cash. I get it. But a pile of cash just sitting there doesn't do anything for investors. What do they do with it? What's the point of all this cash generation? That's the crucial point. This cash is the lifeblood of the entire operation. It's what allows them to reinvest in the business, to build for the future. It's what lets them pay down debt and strengthen the balance sheet. And most importantly for long-term investors, it's what lets them consistently reward shareholders.
And this right here brilliantly illustrates the result of that powerful cash flow. For 63 consecutive years, the Coca-Cola Company has increased its dividend payment to its shareholders. Just think about that for a second. Through the dot-com bust, through the 2008 financial crisis, through pandemics and recessions, this company has not just paid, but raised its dividend every single year for over 6 decades. This is not the behavior of a company with a cracking facade. This is the undeniable proof of an indestructible financial fortress, one that's been forged over decades.
So, it's time to assemble all the components. We've inspected the foundation, we have tested the core structure, we've examined the so-called cracks, and we have drilled down to the bedrock. Now, let's lay out all the evidence and deliver the final verdict on the structural integrity of Coca-Cola.
The case for the fortress is built on pillars of solid steel. You have 5% organic revenue growth, which shows the core business is healthy and has momentum. You have that massive 38% surge in operating income, demonstrating incredible profitability. This is all supported by significant margin expansion, proving they have pricing power and cost discipline. The entire structure is built on a bedrock of $11.4 billion in underlying free cash flow. And that 63-year history of dividend growth, well, that's the ultimate seal of quality, a testament to its enduring strength.
But let's be clear-eyed about this. It's not a flawless structure. The case for the facade, or at least for some pretty significant cracks, can't be ignored. Global unit case volume is flat. They are not selling more drinks, they are just charging more for them. How long can that strategy actually sustain growth before consumers start to push back? There's a heavy, almost total reliance on these price increases. Furthermore, as we saw, the strong dollar creates these significant currency headwinds that are constantly eating into the reported profits. And these large one-time accounting charges, like the one for body armor, they make the quarterly numbers noisy and really difficult to interpret, and they could be obscuring underlying issues.
And that brings us to the final, critical question that you, as an investor, have to answer for yourself. We've shown you the evidence from all sides. The core question is this: is Coca-Cola's incredible pricing power a permanent structural feature of its fortress, a competitive moat that's going to last for decades to come? Or is it merely a temporary shield, one that's working right now but could eventually fail in a world where they are clearly struggling to sell more volume? The answer to that question is what will determine the long-term trajectory of this stock. It's your job to weigh the evidence we've presented and decide if this is a pillar you want to use to forge your own portfolio. Thanks for tuning in to Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.